Expected move bias. How far can prices go? How far can prices go? Let's take a look.
Typically too far.
Always further than you think. That's all you need to know about trading. Always further than you think. An expected move cone estimates the one standard deviation expected price range over a certain period of time. You know, it was a while back, and a guy comes to me and he goes, we were doing a show somewhere, and he walks up to me and he goes, I got this. I designed this, not the expected move cone. I designed a volatility cone.
Really? It's been there for what? 50 years, 40 years?
I don't know. He said, I designed the volatility cone. And I go, okay, what's that? And he shows me. It looks a little like this. And he goes, he was so excited. And I'm like, okay, and you're showing me exactly what? So it was all about expected move. So I think this is probably like 40-ish years old or something. Something like that. But I remember the first volatility cone. Anyway, an expected move cone estimates a one standard deviation expected price range over a certain period of time. So basically, you know, what's going to happen just under 70% of the time. We're going to live in that world. So 45-day, one standard deviation expected move, plus or minus 5.61%. Let's go next slide. So since every time frame has an expected move based on implied volatility, what is the realized volatility we've seen over the same time frames? And how does it compare to the expected move? Well, obviously the expected move should be greater than the actual move, because that's how everything's priced. The expected move is greater than the actual move, and that's why there's a little extra juice in what we do.
Correct.
Let's go to the next slide.
It was perfectly priced. There'd be nothing.
So we looked at 25 years worth of history. We observed the average of all the expected moves over 7 days, 14 days, 21 days, 30 days, and 45 days. We observed the average realized move over the same time period. So then we conducted a study for longer durations of 60 and 80 days. So we go from 7 days to 80 days. This study can be thought of as measuring implied volatility to historical volatility overstatement for various time frames. We're basically just talking about overstatement. How much does implied, which is expected, the expected move, compared to what actually happened? Let's go to the next slide. So the average of expected moves in SPY will be very similar to an expected move in the SPY with an implied volatility of 19.8, since that is the long-term average, since that's the long-term average of implied volatility. And all percentages are implied to be a plus or minus move. So what's interesting here is that you know, some people say, well, it's not 1980, it's 1901. Other people say it's 1807, whatever. I don't care. But you can see the the plus or minus implied moves right in front of you on the screen for 7 days, 14 days, 21 days, for 30 days, and for 45 days. I'm choking on something.
He has a do not resuscitate. Remember that.
Anyway, so if you want to go out and look at 7 days in the future, what did that say, Beth? Go back one slide for a second. It's at 2.6, 2.1. Okay. So in something like, you know, something like the S&Ps on a normal basis, it's like almost 100 and something points. Now we have very low volatility, so it's a fraction of that. Now go to the next slide. So when comparing the SPY's expected versus realized moves over different periods, we found that the 45-day period was the only period where the expected move consistently exceeded its realized move. And that's why our mechanics are geared towards 45 days. Because people say, well, why 45 days? We always say, well, that's the optimal point in the decay curve. It's the optimal point in the decay curve because that's the point where it's the only point where the 45-day period was consistently the implied volatility or the expected move exceeded the realized move. And that's one reason that we tend to stay away from longer dated options. So if you look at the 7 days and the 14 days and the 21 days, you know, and compare that to the 45 days, that's essentially where we are. Let's go to the next slide. However, once we get into the longer dated options past the 45 days, the expected move continues to overstate the realized move. So why don't we trade options with expirations greater than 45 days?
Question?
And the answer is we tend to stick with the 45-day time frame because we see an inflection point of expected move overstatement coupled with a higher average premium buying power compared to longer time frames. In other words, the 45-day time frame is the middle ground for a higher P&L and consistent expected move overstatement. We posted it down here. So you have the 25 delta, short strangles, managed at 21 days since 2005, because we only have 20 years of really good data for this. And you can see that 45 days is 12%. And if you go out to 60 days, it drops to 10. And if you go to 80 days, it drops to 8.9. Does that mean 80 days is bad? No. Does it mean 60 days is bad? No. No, it just
Trying to look at good and better, right, over a long period of time here.
And if you do the 45 days, you can make a lot more trades.
Sure.
And the more trades you make, the closer you're going to be to whatever your expectation.
You take more advantage of that. Right.
It's all about kind of the, again, number of occurrences, law of large numbers. 45 days gives you the chance to make more. And if it has the highest percentage and the chance to make more trades, it makes the most sense in our world.
Yep. Yep.
Let's go to the next
I mean,
slide.
if you were to probably narrow this down to a shorter time frame, year by year by year, you'd probably see a little bit of difference in between all of these. And maybe the 90-day would do better than the 45-day. But all you can do is over time, right? Well, till the end by 65 cents, making new lows. Cancel crash.
Yeah. Cancel crash for now. We look like we had them. I thought we were crashing.
Bonds 114.13. So
They stink.
24 ticks.
Takeaways. On average, longer dated options priced the expected move slightly higher than the actual move when compared to shorter dated options. And the 45-day time frame carried decent expected move overstatement with a reasonable outcome when compared to longer and short durations. You can see here, the differences are not that big sometimes. Mm-hmm. But it's also the difference between hitting, in baseball, between hitting 290 and 310. It's a big difference. 310 goes to the Hall of Fame. 290,
Goes to the Hall of Fame.
I guess my point is, there's all we can do at Tasty is find like these little optimizations that you can do, and that's why the 45 days comes into play. And here's the rationale behind it.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.